So I'm going to ask the panelists to introduce themselves, but this is a very diverse group who will each individually offer unique perspectives looking at some of the demographics, folks who are servicing subprime, people who are operating in the payday space, talk about regulatory constraints on data access, data flows, ability to compete, and how to overcome these challenges, and exciting new solutions right now that are targeting the unmet needs of the credit invisible population, and what can be done with more access to data. So I don't know, is there a preference for how we want to go? Do we just want to go left to right, right to left, tall to short, oldest to youngest?
I'll go first if you like. Okay.
Perfect. Glenn, thank you.
Turn on here. So morning everyone. So I'm Glenn Waine. So I lead the data science and the consulting function for TransUnion Canada. I've been with TU for 4 years and a little bit now. Before that, worked for many years for HSBC Bank in the UK and Canada in various kind of largely analytics and CRM kind of roles.
My name is Elizabeth Sale, and I'm a partner with Blake's. I'm in the financial services group, but my practice is on the regulatory side. I do a fair amount of work for lenders as well as for all of the associated groups that support lenders, including credit reporting agencies. We have a long-standing relationship with TransUnion, but I also do a lot of work with other fintechs and other types of entrants or different types of lenders that are looking at providing solutions to some of the problems that Michael showcased on his slides. So looking forward to talking to you guys about that.
Good morning. I'm Chris Grenack. I'm resident here in Toronto. I work with a company called Trust Science. We basically enable those in the subprime industry focusing on auto, title, installment, as well as short-term small dollar lending to be able to score the invisibles, which is what Michael was referring to earlier on. I'm a CPA by trade. I worked with CIBC as the CFO for their wealth management book for 15 years and spent 8 years with a company called Money Mart North America, basically running 950 stores. So I'm very familiar with both the super affluent as well as those on the invisible side, and we're basically here to enable subprime lenders to provide liquidity to those who otherwise would not be able to get it.
My name is Vahan Derkalusian. I'm a director of data science at Capital One Canada. I'm responsible for our overall model inventory, and I'm also a model risk officer, through which I oversee the development of a lot of our credit risk models as well as some of our fraud models. Big fan of data. My hobbies include constantly asking the credit bureaus to give me more data, and then them telling me that they're working on it.
Tony Vardy, I'm the COO of a company called Progressa. So I'm 3 years there. Company's been around for 7 years. 20 years in the non-prime lending space. So a lot of what I've seen in the presentation earlier, totally agree with it. And I would even say, depending on how you classify it, thin file or invisible, I actually think the population's higher. So very excited to be here and to share input with the team.
Good morning. Jason Appel. I'm the Chief Risk Officer of goeasy. We're a publicly traded company here in Canada and operate 2 business lines. One is a rent-to-own business that we brand under the name of Easy Home, with about 145 locations across the country, and the other one is our financial services brand, Easy Financial, which has about 250 locations across the country. Very familiar with the non-prime space in the Canadian market, and interesting to hear the views of my fellow panelists on credit invisibles. So happy to be here.
Okay. So we should just launch into individual presentations or discussion points. Did anyone want to start with just some sort of comment or response to the findings? In particular, the ratio of credit invisibles to visibles, the associated demographics. Maybe I could just begin by asking the panelists to comment on the findings, particularly based on your own experience in your market segments.
Yeah, sure. So I'll maybe take a stab at that first. So really interesting presentation, and so thank you, Michael, for delivering that. So of course, when we start thinking about, it's interesting looking at some of those sort of high-level kind of segments that you kind of defined, and I guess as part of the analysis as it stands, I guess it wasn't really possible to start understanding, well, what proportion of credit invisibles do we think are new Canadians and new to credit, etc. So that to me would be really a significant area of focus in better understanding the sort of underlying needs and differences, because it strikes me that the needs and also the solutions of those different kind of segments are actually going to be very different to each other. So, for example, we know that many banks today have got, for example, new to Canada products and propositions, and they're kind of pretty active in that kind of space. And then we've got other things like consumers who reach the age of majority, and they're sort of setting out on their kind of lending journey. And I think there are kind of strategies and things that organisations have. Could they be better? I'm sure we can, and maybe we'll talk a little bit about that. But it strikes me that, again, when you start thinking about some of the other segments you define, particularly maybe consumers who are significantly older, indigenous populations in different sort of parts of the country, I suspect that the reasons for their credit invisibility are quite different, and therefore the solutions, and certainly some of the things that you were talking about around alternative data sources, strike me that would be much more applicable to get a better sense on the credit worthiness of that population in a more material way than it would be for someone who just moves to Canada, who's probably doesn't even have a mobile phone or utility bill history or rental payment history. So again, it would be interesting to look at how that sort of shakes down, because again, that will maybe inform the thinking around how to solve the problem when we better understand the underlying segments, would be my thought.
Do you want to just go down the line, or?
I'll skip mine because I'm not in that business, in the industry, so I don't have an industry perspective except for the overall. So I'm going to pass it on.
Sure. Yeah, I'll take it. No, I really appreciated the presentation, and it's echoed everything that I've ever said with our perspective and our existing clients and how our business model is actually structured, and certainly from my personal experience at Money Mart for that period of time. Where, just for a little personal background, when I joined the organization, which is probably now 10 years ago, I'm no longer there, obviously, it was, a fairly diversified book, but about 65% of the revenues were from payday. And with the regulatory headwinds that were occurring, and as far as constraints being imposed in that book, as well as in the fact that, from my personal perspective, it was very difficult to collect because you had like 50% default rates. It was not an affordable product. And a lot of these folks, you're trying to sift through the prime, to find the subprime, supposed subprime, to find the prime, those people that you want to lend to and are deserving the credit. But, and no offense to the TU folks and the folks 10 years ago, the data wasn't there, and it was not predeterminative to be able to predict risk on that no-thin file. And therefore you were forced to charge enormous amounts of rates of interest just to recover your operating expenses and your default and your high cost of capital, because all the finance companies were charging at least 15.5% to 17%, if you can imagine that. But the one thing I would say, and everything you've indicated as far as the demographics and the lack of liquidity that these folks have and how challenging it is, I would echo with exclamation marks. And I understand that what PERC's objective is to make policy changes regulatorily wise across the world, and I support that fully. Your definition of alternative data is still, in my opinion, as humble as I might be, financial-oriented data, financial transactions. And so the world's expanding beyond just strict financial data to include things like alternative data. With the proliferation of alternative unstructured data in the world. 97% of the world's data is truly unstructured today, largely because of the proliferation of the mobile phones and the internet. Yet that's untapped. And with AI and ML and other mechanisms, you can consensually, in a permission-based means, acquire data on individuals and get a really good perspective on their risk profile based on their behavioral traits. And there's a lot of studies supporting that. So I've probably taken up my 60 seconds of time. But
No, you've created more questions for later, but and we'll get to, because actually some of the unstructured alt data, the experiments are happening in very unregulated markets out of necessity, because you really, so we'll talk about the challenges with that, but I'll note that you were the first to say AI and ML.
It won't be long.
Is that a good thing?
Yeah, good thing.
I can contribute to that. First thing I noticed, I was thinking, from my experience, we're pretty in the trenches with the stuff as a primarily subprime lender, and I caught myself lumping in the entire credit invisibles population into subprime, and a few of us did that already, and that's a great demonstration of the challenge we're facing here. And yeah, there aren't great solutions out there. We do our best. The numbers that were put up there in terms of, broadly speaking, what proportion of the population we think are invisibles, it does roughly align with kind of what we see coming through the door. The current state of affairs is, if you're lucky, you might have one odd trade line on a thin file. Otherwise, you got an application form that's shoddy at best. And then you end up relying on kind of postal code averages. And there's something just that makes you uncomfortable about deciding your credit based on your 10 neighbors and what they did in the last couple of years. So we're actively looking into expanding the range of data assets that we can productionize and ingest into our automated underwriting. And there's an ongoing and very rich conversation with compliance and legal about which one of these assets are, will fall under the umbrella of responsible lending, fair lending. If you just think about when that application form is submitted, right at that point in time, there's already a mountain of digital data coming in from that session and the click stream and how much time they spent hovering over each field. Did they read disclosures, what they did? And so, A, yeah, how stable is this stuff? Do you want to use it? And B, is it fair to use? Is it a proxy for something? So there's a lot more conversations to be had, but we are fully bought in that there is a lot of data we are not looking at right now, and it's causing a lot of harm in the market. Because not to take a stab at Money Mart, in our minds, every time we decline someone for a credit card because we don't have enough information, there's a chance they might go get a payday loan, and so we'd rather avoid that.
Yeah, I guess first I would say I dislike the word non-prime. So 20 years, companies like goeasy, Mogo, I've been in the industry for a while. Really, when I look at non-prime, there's just two problems happening in Canada. And this kind of goes back to your stat you showed about the debt. There's limited access to credit, but on the flip side, for someone that's deemed prime, there's too much access to credit. So I think the whole Canadian lending model is somewhat flawed at times. I think, as lenders, there's things that we should be doing to be a little bit more socially responsible or tightening up in how we manage debt as a country. Progressa, when I look at, we're a lending company, that's how we make our revenue, but the reality is we've spent the majority of our investment of time, human capital, designing credit models that looks past the credit report. Credit report in my world is simply a fast knockout rule. Is there an indication of fraud? Is there anything that's like sort of at a top layer that we can eliminate or triage someone out of our pipeline? But then we got to get in and actually make a real credit decision. And that's where it comes into the alternative data, banking, affordability. I mean, there's a lot of room to grow in this country, and I think, knowing what the banks can and can't do, definitely there's an opportunity to, I think, more align with fintechs and look at alternative ways to underwrite your consumers.
Yeah, I would echo Tony's comments. I think as an alt lender or a non-prime, subprime, whatever you want to refer to it as, I think we face a couple of common challenges that builds on the information that was shared in the presentation. I think if I had to sort of bucket them into two or three categories, one is the willingness of consumers to enable the sharing of that information with borrowers. It's easy for customers to give a consent to get a credit report because customers have been doing that for 25, 35, 45 years. It's not new. Getting the customers then to give you the consent to perhaps turn over their banking information, their social media data, other sources of data may also be a challenge. But let's assume for the moment that we could overcome that in how we deal with customers. The interesting thing is then how to integrate and seamlessly put that data together and build these sort of next-gen type models that can leverage that information and do it in such a way where the customer doesn't feel any increased levels of friction. Because one of the things we see, again, as a lender in the non-prime space, is that a lot of these customers don't come to banks because they don't want to go to banks. They are purposely staying off the radar. We see it in our lease-to-own business where the majority of customers come in specifically because we don't pull a credit bureau. And it's not because these people are worried about what's on the credit bureau, it's because they don't have one. They already know that they don't have one. So it's coming up with different ideas on how to entice these individuals to come into your environment, willingly share that information with you, and then do it in such a way where you can seamlessly integrate it and make it easier for the customer to then transact and do business with you. I think for those lenders and indeed regulators who will help facilitate that journey, you will find the ability to integrate the credit invisibles will be a far less challenging proposition than it is today, at least in the Canadian market.
So it's interesting, in the aftermath of the earlier presentation, I was chatting about what are the surprises, and one of the references was the size of the credit invisible population, particularly even in Toronto, right here. But the practitioners who are working the subprime, non-prime space, and I know in all deference to hating the term, I hate the term, we can use credit invisible, but working to meet the unmet needs of credit invisibles weren't surprised. They validated those numbers. So that, to me, as a researcher, is encouraging when practitioners are saying, yeah, this is what we see. And I think there's also a consensus among the practitioners that there's a need for more data. So that validates the proposition that predictive data is being undersupplied. And by the way, again, not to the fault of credit bureaus. So I want to talk about data and pain points and policy. I had some policy recommendations, and I'd be curious about your thoughts on the likelihood of successful mandatory reporting or mandatory use provisions in Canada, open banking, and what are the consequences from that. And I'd be particularly interested in our colleague from Blake's, if she could discuss from a legal regulatory perspective some of the constraints and concerns, particularly around unstructured data, because it seems to me that what's keeping that out are fair lending and non-discriminatory compliance requirements, and whether there's a possibility for sort of a arm's length or sandbox approach.
Sure, that was actually quite a lot of questions in there, but let me try to at least let me try to unpack some of those things and touch at least on the ones that were at the end of Michael's statement, because those are the ones that now are in my mind. Lots of interesting things are happening in what I'm, the work that I'm doing. One of the challenges from a policy perspective is that the law is always like decades behind. So I think what I'm hearing from my panel here is that when you're in the industry yourself, you're already an alt lender, your solution is to try to build something from the ground up, to try to get ways to entice your customers to provide you with that data. And because of our privacy model, which is consent-based right now, there's a lot going on in privacy, but that's what we got now. These things are possible with the right, incentives and disclosures and all of that. But what is interesting is that when we're talking about, the proportion of customers that the big banks have versus alt lenders, we are still in Canada. We've got lots of alt lenders, but the banks still have a huge number of customers. And so when we're talking about scale, those banks, due to their legacy systems and what they have, their own problems in shop, they're looking to partner with fintechs to provide some of these alternative sources of data. They're very risk adverse in terms of who they partner with because of their reputational concerns. So they're looking for people that they can show to their execs are solid, they're properly licensed. And that's where we get into some of the cruxes of the credit reporting issues. To be a licensed credit reporting agency in Ontario, you need bricks and mortar. So when I'm talking to fintechs who are looking precisely to provide information that would target the populations that Michael was talking about, like bang on, and they're trying to look at pilot solutions, partnering with banks, the banks will say, do you have all the right licenses? And they will ask me, do I need to be licensed? And I said, well, there's some arguments. We can talk about, are you just a conduit of information so that you're not really doing anything, you're not manipulating the data? But of course, then that's not useful. If you're just kind of plopping things through, you are just showing the information, but you're not showing it in a meaningful way. As soon as you start to manipulate and provide reports, because the definition of a credit report is like ridiculous. It's just like a report with any personal or credit information on it. So you're sort of trying to figure out a way that you're not a credit reporting agency with this broad definition. It's kind of hard, and I can't say 100%, no, you are not a credit reporting agency. So they can't go to their more risk-adverse partners and say, no, we don't need to be licensed. Governments on the whole are also risk-adverse. So when Michael was talking about a sandbox, that would be a great idea, but there's not a lot of an incentive for regulators, particularly on our little provincial basis. Ontario's maybe more sophisticated than others, but there hasn't been that much focus on it, and it is province by province. So I think you're going to have a little bit of a challenge getting into a sandbox mentality, because that requires a leap of faith from our regulators, and I don't think that we have that. So there are some challenges, but there are also lots of solutions. I mean, I am hearing that there's in-house solutions. I am talking to those fintechs that are providing, they're out there. We're just trying to work together to figure out ways to get that information, and maybe it's a little bit of baby steps at the moment, but there's lots of good work going on there, and lots of interesting products to get people to a stage where they can build reports. So maybe we're also working within some of the traditional models, and goeasy is very active in that, and they've got some great partnerships. I don't know if Jason wants to talk about that later, but I've been working with both goeasy and those partners, and it's really interesting work to try to, these products that when I was first presented them with them, it was like a big question mark over my head. I'm kind of like, what is this? And once it's explained to me, if we can get together and explain those things to the regulators, to the people that are making our policy decisions, I think we can do some interesting work.
Others on the panel want to speak to any sort of data pain points, any promising opportunities with open banking potentially on the horizon, et cetera?
I can comment on a thing you mentioned earlier with some folks are exploring even maybe building solutions themselves, and how that's probably not sustainable. We wrestle with that, and the problem is, the more you think about it, the more you realize this battle is going to be fought and won on the regulatory side. We need better data sharing standards and policies and practices. Open banking, if done right, could solve a lot of these issues. Regardless of who's standing up the infrastructure, even if it's a new entrant that's trying to build up a database of alternative data sources and create actionable data products to sell back to financial institutions. The problem is, how are you even going to get that? Is it like a wet scrape? It's a weird adversarial world wherein the banks don't not allow it, but they don't really allow it either. On the back end, they're trying to fight it, but on the front end, they don't really say anything. So I think there's a huge lever there in just trying to make some broad declarations in terms of how we're going to share this stuff and make it mandatory.
Yeah, open banking is still pretty early days at this point, and it's there's lots of models to look at in other countries, but here we're still at the ongoing consultation phase, and yes, there's lots of different stakeholders here that have very different views on what that's going to look like, and obviously privacy and fraud concerns too, which it's in everybody's interest to have those conversations.
Yeah, so it seems so. Open banking, of course, is one of those. You joked about machine learning and artificial intelligence. It seems like everyone has to. We all have to get these things into the things we say. And open banking is becoming one of those things. And of course, as we think about what happened in the UK, and I think as was pointed out. The regulator, I guess, has kind of driven the large banks and financial institutions to the table to sort of make that more of a practical reality, and I guess we'll kind of see how that sort of plays sort of out here. It seems to be gathering some pace, certainly in Canada, from the conversations that I and my colleagues at TransUnion are having with clients, and there's certainly growing interest. I guess it kind of remains to be seen. Again, as I go back to the point I was making before about the underlying segments and the reasons for credit invisibility. Because Jason, I think, mentioned on the answer to the previous question about the reality that many consumers simply are deliberately off the map. And so when we think about what open banking really is, and it's essentially, we're still talking about the sharing of financial information in one sense or another. So again, it would be interesting to kind of see the extent to which an open banking solution in Canada would go towards sort of helping us to solve the credit invisibility problem. And so my point is, it may do for some segments of it, but perhaps not for others. I guess the other point that I was thinking on as we were kind of going down the table before was around alternative data in general. And of course, our focus at TransUnion in the recent past has been to look at, okay, well, how can we do more with the existing data that we have? And so, we've got, like, our credit vision score, for example, is not a sales pitch, although I'm happy to chat if you'd like to. But that's really looking at how we can take, typically the same kind of data that we've kind of always ingested from data furnishers, and actually looking at it over different time periods, over like a 24-month time period or 36-month in some cases. And that helps us to augment the performance of a score there. And then, of course, we start thinking, okay, well, how do we then look at different sort of, I'm going to use AI and ML here, but how do we look at more modern or more sort of cutting-edge sort of modelling techniques to enable us to sort of push that further? And alternative data is another area again where I think that we're certainly very keen to be exploring how we can look at other sources of data to again further augment sort of score performance, whether it be in terms of scoring more consumers, which obviously is one of the problems we're discussing about how to solve here, as well as actually just enabling us to get more data and therefore enable our clients to make more sort of informed decisions about consumers as well. But the point about alternative data, I think, is that I guess it's an all-encompassing term that means lots and lots of different things, isn't it? And so when we start talking about unstructured data and we start talking about social media data, there are obviously elements within there that we've got to try and ensure that there's some degree of objectivity about it when we're talking about using it in the business of making decisions whether we're going to lend to someone or not. So, whether someone clicks on a bunch of pages or likes a number of things on Facebook or something, that might be interesting and might be useful around the edges, but in a situation where we're talking here about consumers who have no real meaningful financial data upon which organizations can base decisions, how comfortable is an organization going to be on rendering a key part of their decision based on data which is not necessarily very objective? So I guess definitely some potential, I think, for us to continue to explore alternative data and its applications, but I think it kind of depends what that data source is and what the intended use of it would be also.
Just a small point on that open banking. One of the things that I was very struck by coming out of the UK experience was that so few people understood what open banking was, even several months after the implementation. And I would expect that those that were using open banking, although I have no data on this, but I would expect that they would be more on the sophisticated side. So I think that
I think you're right,
backs
yeah.
up what Glenn was saying.
Yeah.
So, and I want to piggyback on your comment. I think it is important, particularly in our discussions with regulators and policymakers, that industry have a clear demarcation between structured and unstructured data in a risk assessment context. We call proven payment data sort of the non-financial credit-like data that we were talking, energy, utility, telecoms, media, and that seems to help. And the other bit is that there are over 90 countries globally in which different elements of proven payment data are already used for credit risk assessment. So it's not that you're putting your neck on a chopping block and pioneering a practice. This is a very well-established practice in a range of countries, from the UK to Colombia to Kenya. So, the concern has been that with all of the emphasis on big data and AI and ML and everything being called alternative data, that the regulatory uncertainty, the fear, the apprehension about unstructured data would delay market access to the structured data. And so I think, just a side note on that. Interesting in open banking, I'd be curious as to your thoughts. I know there's great interest in the U.S. in API access to bank data, to depository account data, so you can see regular payments to utility companies or landlords, and get also VOIs, for verification of income from paycheck deposits and so forth. So two things. I'd like to know what's being done right now for VOE, VOI, VOA, particularly for thin file, no file, and what are any promising solutions, particularly non-manual, emerging. But also talk about limitations of, everyone's excited about open banking, but here's my concern. I see that I'm paying Rogers or Bell, a different amount every month, but it's not going to say in my bank account whether that's timely or paid in full. Similarly with rent, similarly with all of these other variables that you would have on a traditional credit line. And how would you overcome these limitations? So I'll just open it up to anyone on the panel who wants to respond.
You want to take it? I think you got to look at it very carefully. I think the number one reason why, even if we don't move to an open, can you guys hear me okay? I think the number one reason why it'll take a while for the proliferation of banking data to weave its way into lenders, and we've been ingesting it now electronically for about 2 years now. And we are just building now our first generation banking integrated or hybrid models and standalone models for invisibles or deserts. And that requires lenders to take some challenges and some risks, because if you truly want to understand how predictive, among other things, that an alternative data source could be, you have to ingest it on a population of people, a portion of whom you would expect to go bad. Now, if you're a publicly traded entity like goeasy, or even a privately traded organization like Progressa, you have to have an organizational management team that's willing to take that risk and do it with enough sufficient critical mass that you can glean enough intelligence and learning. And I won't speak for my friends in the prime space, but generally losses in the non-prime world lag anywhere from 6 to 9 to 12 months. You can find quick indicators like first payment default rules, but as a conservative lender, even though I work for a non-prime company, I would still tell you you're going to need a little bit of data underneath your feet before you can get the confidence to begin to integrate that information, assuming you can continue to get enough customers who'd be willing to give it to you. So I think open banking, whether it comes or doesn't come, I think there are ways for lenders to get around it, but there is a natural time displacement that's going to occur because you need to do your homework in this space. Because if you get it wrong and you go big first, it can spell disaster, a la auto finance and the examples you gave at the introductory part of your panel. So I think we as lenders just need to be very careful about how we ingest it. And again, as I'll say before, you've got to be very careful in being very upfront with your customers on how you're getting that data and what you're using it for. Because the danger I fear that we're going to run into is that if we don't move to an open banking platform, and lenders aren't upfront about how often and when they're pulling that information from their customers, it only takes one bad apple to ruin a bushel. And that could spoil it for all lenders. Because we're not doing it to be nefarious in how we treat, underserviced customers. We're doing it to be helpful in an effort to bring those customers into the fold, in an effort to help them advance their needs for credit. And I think that's a very fine balance that lenders have to be careful about, because you could get it wrong just as easily as you can get it right.
Others on the panel?
Yeah, I mean, just to quickly add to Jason's point, I think, open banking, one, personally, I'm excited, Progressa is excited, but I think there's, there's two sides to open banking. One, even though I'm a fintech, and I would say, again, banks should leverage fintechs more, but on the flip side, you get organizations that don't have the proper controls, compliance, or rigor around sensitive data. It could just blow up and basically ruin for everyone in the space. Second, any lenders in the room or people that are thinking, let's go get creative and just figure out alternative data sources to go blow up a loan book. On the flip side, sit down and try to defend it for a securitization or try to get a $100 million facility. I think, as lenders, it's easy to look at alternative data now and decide what you're going to use to approve a customer. But again, to Jason's point, you got to get a track record. You got to learn what you don't know 6 months from now. How are we going to defend that this is actually prudent information to get the proper financial backing? So I think there's a lot of aspects for people to think about versus just let's go find some new bank data to make a credit decision.
Others?
So I'll talk more to the unstructured piece, and two aspects, I guess, really. One, from a regulatory perspective on privacy, and secondly, I guess, from the perspective of fairness. And so, stateside, it's FCRA and ECAO, fair lending sort of requirements. On the privacy piece, if information is in the public domain, then you don't really require their permission. They've already placed it. If, the millennials, which now represent, I think 48 to 50% of the population, if you can believe it, are very willing to open up information into the public domain. And if you can get your paws on that, data size and data quality matters. And then secondly, if you can actually incorporate that into your loan application process and establish mobile applications that on a very clear means by which says this is what you're providing access to and it's restricted in use for purposes of adjudicating this loan, I think you can get across the finish line. in as far as fair lending is concerned and equitable lending, if you can explain what the AI and ML requires adult supervision, right? So it requires supervision on an ongoing basis to make sure that the models are not either deliberately upfront incorporating, age, gender, or race as an example, that it may be construed as being discriminatory. Well, definitely is discriminatory. Or other ones that are inadvertent, just by virtue of the fact that AI and ML, data doesn't lie, and it doesn't have any personal biases. It just calls a spade, and if these are the relationships, and this is sort of the scoring that it attributes to an individual based on all the profiles of that person, it may be biased, and therefore, at least what we do is we actually have managerial supervision of the models to ensure that relative to the general population that we're scoring, there's no outliers, and it's not as though this particular cohort or segment is being adversely impacted and adjudicated, unfairly treated, if you will. And actually, we've gone a step further because we don't trust ourselves internally. We never want to color outside the lines of the law for obvious reasons. We've actually hired a third-party data analyst team to examine our models and ensure that they're non-discriminatory. So I think that all the issues that you've raised are bang on. I think there are means by which, where there's a will, there's a way, and there's a need, I think we can get there.
I think the question I would have on unstructured, which I find fascinating, and we've struggled with it quite frankly, is because, at least in our exploration of that information, in our discussions, because it requires such advanced modeling techniques to be able to, never mind just cleanse it, but then just to go out and make sense of it all. Imagine a world where credit bureau data doesn't exist anymore. So I can look at a credit bureau report, and I can look at a TransUnion CV score. That's a free plug for you, Glenn.
Thanks, Jason.
I can look at a CV score, and I can get the risk factors that will tell me, assuming I know how to read them, the top 4 reasons why that customer has a score of X. It's very understanding. The customer may not know it, but I, as a lender or a frontline adjudicator, I can kind of make sense of it, and I can explain it. Imagine a world where that doesn't exist anymore, and now we're ingesting unstructured data, and it's embedded in a neural network model. You try and tell a customer that they've been declined because of reasons that your model can't even explain, or it isn't transposed in a way that the customer is going to understand. And if it's in relation to data that they don't understand as being structured or unstructured, you will get a backlash in the environment for customers who are going to say, well, I'm not going to give you that information because I don't understand how it factors into my decision in the first place. Now, that's not a reason not to get into the unstructured data business. I actually think that's a reason to get into it. The challenge is how do you make it easier for the consumer in an increasingly global world where the customer is trying to put themselves at the center of the universe, and we believe we're trying to service them. How do you get in front of that customer and explain to them how that unstructured data actually plays into the credit decision? Because if you can't do that, you're going to find at some point, maybe not today, and assuming you can't get, let's call it aggregated data, the customers aren't going to want to give it to you unless you give them something in return. I'm a big believer in give to get. The only way you're going to get banking data or unstructured data, if it's not already anonymized, is you're going to have to give something to the customer. It may have to be a rate reduction. It may have to be a commitment that you're going to give them at least a certain amount of money. But it's a give to get world that we're moving into, and I think lenders have to be aware of the fact that they're going to have to make conscious trade-offs if they're going to want to bend, never mind break the rules as it concerns credit invisibles and deserts. You're just going to have to. So I'll find it interesting as we progress into a world of both structured and unstructured alt data and more advanced machine learning type technologies, and how the customer is going to make sense of all that when we start to explain it to them when they're not approved for credit. Never mind when they're approved. They're not going to complain when you say yes, but they're sure as hell going to complain when you say no. And notwithstanding the fact that we've made huge progress in AI and ML, you're still going to be declining a lot of customers in the prime space, and the non-prime space in particular. So it is an interesting challenge, I think, that lenders and service providers alike and bureaus face all at the same time.
Yeah, it is, just to sort of comment on that as well. And so I think that the reality is that we know that using more advanced modeling techniques than the traditional logistic regression kind of methodologies does yield significantly, or can certainly yield significantly better results. So on the one hand, you've kind of got, I think, the benefit of being able to be able to create models that frankly just simply work better. And as Jason was talking about there, on the other side of the coin, you've kind of got, okay, but to what extent is it explainable, and how does a regulator get a level of comfort that a decision that's made as a result of that methodology can be sort of explained. But I guess what I'm kind of seeing as we're looking internally and also talking to sort of our own clients and some of the bodies of work that they've kind of undertaken, is that there's enough potential benefit from all that stuff that I think that there's a keenness and a desire to find a way of making that work somehow. So whether that's watering down some of the elements of the machine learning components so that it is a little bit more explainable, but I think that we'll find over time that we'll become more comfortable as a country and an industry in being able to do that, because there's so much benefit potentially to be gained. But just to come back to I think one of the problems the key problem that we're trying to sort of solve for here is that as we think about, we're talking about structured, unstructured and structured alternative data, and we're talking open banking. And I think that, again, I come back to those segments and I think about what would be really interesting to me is when we think about, for example, new to Canada. Now, new to Canada is a significant component. We've got hundreds of thousands. I think you had maybe 1 million, I think, on your slide, Michael. But we've got, even from a study we did a couple of years ago that we presented at our summit, we kind of looked at the differences between new to credit, so typically consumers who are becoming 18, and then typically consumers who are much older and have immigrated to Canada maybe for their work or permanent residency or type reasons. And I guess the solutions to enable organisations to make more effective decisions and to be more financially inclusive are going to be different, aren't they? So when we think about new to Canada, for example, then I think, as I said before, the organisations in Canada typically have got processes and mechanisms for being able to grant some credit. I think the challenge is typically they're maybe not getting the best deal on price, and they're maybe getting sort of small limits, and there are kind of issues around that. But the solution to that is probably in being able to actually acquire more information on those consumers from their home countries. So, I know I moved to Canada 10 years ago, and I guess for a period of time would have been considered a credit invisible myself. But of course, that's pretty frustrating for a period of time because you kind of think, hang on a minute, I had a mortgage back in the UK, and we kind of paid all our bills, and we got credit cards and things. So the challenge there is how can as an industry can we enable my credit history in my home country to enable a more effective decision to be rendered here. And so that I think is enabling that kind of functionality, I think is an important way to solve the new to Canada problem, which I think will be a significant proportion of what we got there. Open banking is interesting, as we said before, but again, I think it remains to be seen. And what's not clear to me, I guess, is when we start thinking about consumers who, we use some of the examples that are in maybe sort of rural areas, maybe they're off the sort of radar, they don't have any sort of traditional kind of credit products. I guess the question I would have is, do these people typically have bank accounts with lots of transactions in there to enable us to do that? I don't know whether the answer to that is yes or no, but it would be something, maybe it's a qualitative research question to sort of address when we start thinking about how do we solve for that. And then on the final point around alternative data, I guess, again, that will help us to potentially solve for other sort of segments of the credit invisible problem as well. And so I think it's nuanced, isn't it, I guess is my point. And there are potentially very different kind of solutions to help us to sort of crack this nut.
So maybe before I open it up to the audience for questions, and I'm hopeful that you all have many questions. I'm amazed at how attentive this audience is. Normally, everyone's plugged into their cell phone, and only that guy was. So pretty good. But I want to go back to a question I asked about mandate. I mean, look, the major lenders in Canada and anywhere are necessarily conservative. Testing a new data asset retrospectively, live, et cetera, it can take years before they make a decision on a new risk assessment mechanism. Similarly, open banking is on the horizon, but that could be perpetually on the horizon, incremental. There's no sandbox, and there's a need for competition. This is an ossified oligopoly in banking, which ignores large segments of the population. And if not fintech, then who? And if fintech isn't empowered by data, where's it going to happen? We're doing an analysis right now because of the sort of the global focus on privacy, but because of breaches in the U.S., it's come to the fore in the U.S., and now industry is clamoring for a federal privacy solution because states are acting. California Consumer Protection Act, which would levy a fine on a breached entity for between $100 and $750 per breach victim, even without a demonstration of harm. So we're Equifax post CCPA, $1.5 to $2 billion in California alone. You put that on the nation, it's a company killer. I've been in meetings with Experian and Microsoft and Google where they're saying we want to empower the FTC. We want the FTC to be more active in privacy regulation. I never in my lifetime thought I would hear that. But one of the things we're looking at is the role of data and innovation. And what we're seeing is if you look at the top tech industries globally, they're concentrated pretty much in the US and China and some in South Korea. And why? And what do they have in common? What are the differences? But one of the commonalities is how they regulate data and the ability of tech firms and then industries that take those applications to innovate with data, to think with data. And GDPR came and it looks at privacy as a human right and puts serious restrictions on the ability of companies to use data and make decisions about individuals, which by the way is what a credit score is. There's some reason to think that one of the explanations for why you don't see many dominant European tech firms is because of those data constraints. So we could talk about nuance, we could talk about over the horizon. I'd like to talk about that every year that we don't have the data solution, the economically underserved, the thin file, credit invisible, no file populations have to pay more than they should for credit or can't get credit access, can't build assets, can't build wealth. And that's social and economic injustice. So let's talk about a crude instrument like a mandate for reporting proven payment data, data that we know is predictive of credit risk, data from companies that are creditors but are pretending they're not. Just yes or no, going down the line, would you support in Canada mandatory reporting for energy, utility, telecoms, and media payment data? And would that help with competition and meeting the needs of the unmet credit needs of the credit invisible population?
Short answer, yes. I mean, more data is always going to enable us to score more, score better. So, yes, for sure.
Well, I'm the lawyer, so I guess I have to figure
I
out.
mean, you can't say yes or no.
Yeah, exactly. I don't think I can say yes or no.
Malcolm Gladwell point. Just gut reaction here.
I think it's interesting
In
and
principle?
interesting in principle, and let's chat.
I would say yes, to echo what was previously said. Data size and data quality matters. I think there's definitely an imposition on the vendors in that space where now they have to create an infrastructure by which that they may have not, if you're a landlord as an example, report upon. And there's also impositions on privacy where you can't just impose upon that. In the case of credit bureaus, whether they're financial or direct, or unstructured, I should say, in both instances, it's consensual. So you've got privacy issues as well that I think you need to consider. So I'm starting to, after I've said my position, side up with my lawyer friend here.
Well, I'm a realist. I'm not holding my breath for some type of decentralized standard to be able to get all this data on demand. So absolutely, please mandate it, give it to the credit bureaus, and let me buy it.
And we'll be happy to sell it to you.
Yeah, 100%. I think more is better. Again, but it's just based on the accuracy. Make sure the sources are properly vetted and then properly classified with the credit bureaus.
Yeah, I'd build on Tony's comment. I think you've got to be very clear on the application and the usage of the data if you're going to be required and obligated to report it. And I would say it not only just extends to what you would call utility payment, cable type data. I would also say that the bureaus must move forward and mandate that anybody who is going to use credit for adjudication must report their trades to the bureau.
Yes.
We must have a level playing field in the
Yeah,
country.
and in all deference, and I want to talk on the privacy and the principle of reciprocity. I understand, there could be a private sector solution if the bureaus would simply apply universally the principle of reciprocity, give to get. But they're a business, and they're usually publicly traded, and they have shareholder responsibility, and they're getting a lot of money from end users who aren't reporting. So it's awfully tough if you're a CEO of a company to say, we're just going to forego tens of millions or hundreds of millions in revenue to apply a principle. So there's a realistic business constraint.
So I would agree with you.
But-
I work for a publicly traded lender that's also in the business, dare I say, of making money. but we also want to be a responsible lender. And if we can't get the customers individually to provide that data on their own and integrate it into our data structure, I would much rather put my trust in another publicly traded entity, like a TransUnion, or maybe an Equifax, to do it, and have the ability to know that the housing, as Tony said, the organization, the structuring the data is on the right playing field. Because the minute you start to give individual lenders that right, now all of a sudden the playing field isn't at level. And I'm okay with that if that's what it has to come to, but I would much rather have a universal approach so that the customer is not left wondering, well, what are those goeasy guys doing? What are those Progressa guys doing? Because it's not the same thing, and there's no visibility, and I don't have an idea. And all of a sudden, the minute something bad happens, I'm going to class action sue him, and his best friend at the same time. Like that's what we as responsible officers of shareholder-owned companies have to also participate in. So I think you have to look at it from both perspectives.
And just on the privacy, the research we've done, people are very comfortable with an existing framework. That they don't see any really privacy concerns with the fact that my payment data of my cell phone is being reported. And right now, by the way, Canada permits default or delinquency and default data for media and utilities to be reported. So you're in the position then of defending the fact that it's okay to report non-payment, but it's a privacy violation if I report timely payment. That's preposterous. People are very comfortable. It's not who I'm calling, when I'm calling, am I dialing 900 numbers if those even exist anymore. It's not my web surfing habits. It's just I have a relationship with Bell. I paid $78 last month, full stop. There are universally, high comfort levels with that information. It's really not perceived as any different, and the fact that it fits nicely into a well-established, decades-old data sharing framework for well-established purposes and uses with consumer protections. The privacy protection is you can just say, no, you can't access my credit report. That's where the consumer has control over data. So, okay, with that said, I did want to open it up. We've got, 20 to 15, how much time left? 15 minutes. Questions from the audience, and please be questions, because I've run out.
I'll go with a question.
Please.
So
So if you could just introduce yourself, say what organization you're with, and then
my name's Simon Howard. I work for a company called EO. And a year ago, I was a credit invisible.
Australia.
No, UK. Everyone says I've been here too long now my accent's...
The Dun and Bradstreet in Australia has changed their name to
It's a
Ilya.
London accent.
So, yeah.
But no, so a year ago, I was a credit invisible, okay? So I found it really hard. When I first came here, no one would take any consideration like yourself. I know what you have to do. It was painful. I've also lived for open banking, so I've just kind of seen how that progressed. And I was part of open banking project back in the UK. The biggest challenge, I think, for you guys is going to be communication around open banking and actually the fear of sharing data. So that's what we found. But I would have loved to have done it. But I'll tell you one thing. When I first arrived in Canada, I got a Capital One letter through the post.
So
You could be our first one.
Yeah, $300.
And I get bombarded with, take this loan out, take this loan out. I hear it on the radio, I hear it on the radio. In the UK, when open banking was launched, there wasn't a single advert that said, open banking is the greatest thing ever coming to this country and you should sign up for it. And because of that, no one knows about it. And if you don't know about it, you don't trust it. So in the same way a lender doesn't trust someone that they don't know enough information about, the consumer's not going to trust something that they don't know enough information about. And I think that's the thing, is communication. I think that's what's holding back people wanting to be part of this credit world.
Great
I
point.
just wonder how you guys are trying to get your message across. So that's the big key for me.
Yeah.
We can either, does anyone want to respond to that, or do we want to batch questions? Are there other questions, maybe? All the way in the back.
Thanks. Steve Boland from Infor Financial. I mean, there's a lot of entrepreneurial companies in this room. Canada's very unique in terms of the oligopoly with the big banks, which really haven't been mentioned very much in this discussion. So I guess I'm curious about, when you talk about initiatives and open banking, how are you going to fight the big banks and their influence on regulators and, the government's, protection of the big banks? So some of these companies I know, but, I'm just curious about your thoughts on how unique, and then maybe, Michael, you can talk about your work all over the world, how unique Canada is in some of these initiatives and how the structure of the Canadian financial markets.
Okay. Other questions?
Erin Maloney, I'm from CanCap Management. I know Jason spoke a little bit about the
danger of rotten apples or bad actors in our industry, especially when we start moving into the use of alternative data. So I'm wondering if anyone has any idea or thoughts on how, as an industry or as an association, we defend against that and communicate with our customers or our potential customers that we are not that we are responsibly using their information, and find a way to freeze out the people who are not doing that.
Okay, so panelists, we've got communications and trust building. We've got how to contend with the government protection of entrenched oligopolistic banks, and whether there's a co-opetition or competition between fintech and the big five, and if the latter, what can be done to make sure it's the former, and then brand protection and weeding out bad apples in the alt data space. Anyone?
I can speak a little on the big bank side. So in addition to working with fintechs, I also do a lot of work with the big banks. And I was speaking about open banking not so long ago, and was looking at the big bank experience with open banking. And one of the things that I thought was quite interesting was that some of the big banks that got into open banking early, and I'm talking worldwide, and one of those was Santander. And they were big proponents of open banking because they got ahead of the curve. And so I don't think it's necessarily going to be the case that every single big bank is going to be opposed to big banking or open banking, because there are proven results out there in the global marketplace. So that's sort of thought number one. The other thought is that technology will continue to advance. And so I think at a certain point in time, you're going to have an environment where it's possible that open banking is going to be somewhat of an inevitability. And so it depends on how everyone reacts to that. But technology will continue to innovate and grow. And at one point, regulators will need to take notice, which they are doing already. And there are some regulators. So sure, there's the Minister of Finance who wants to make sure that banks, and OSFI, that there's a safety and soundness principle there. We don't want banks failing because there's something like open banking has been implemented poorly. But on the other hand, you have open banking being championed by the Competition Bureau. So we have two fairly significant regulators in Canada who are on this, have different views, and are talking about this.
Yeah, just to add, I'm not sure. Elizabeth would be better to comment on the relationship between Canada's big banks and OSFI and other regulatory kind of bodies. But just thinking back to sort of Simon, I think it was Simon that asked making the point before about we think about the UK market. So the UK market is not massively dissimilar in many ways in that it's dominated by a relatively small number of banks, as opposed to the US, where you've obviously got a massive proliferation of bigger, medium-sized banks as well as the giant banks. So I guess even in that sort of environment, in some ways a similar kind of market in terms of the players and the relative dominance of those players, I guess open banking has still prevailed, and not without its issues and lessons that can be learned by sort of other countries in different flavours of implementations elsewhere. But again, I think it becomes the regulator taking a position that to represent the consumer, doesn't it, and what's in the consumer's interest, and really sort of compelling the banks to sort of adopt that. But again, I don't know whether you'd have a view about whether you'd feel that there's a different. I'm putting you on the point with a question from me. I'm not supposed to ask questions. I'm supposed to answer them. But I wonder whether there's a different sort of environment where we maybe feel. I think it was Steve in the corner that was asking the question about the bank's influence on the regulators in Canada, and I don't know whether that's a factor here.
Yeah, I think it is a factor here because the banks, like everyone is lobbying one way or another about open banking. I open up the Globe and Mail and there'll be a letter from someone in the opinion section about open banking. And they come from all sectors. So everybody is thinking about this and talking about it. And the big banks, they do have a massive market share. I don't think it's a secret that they would be interested in protecting that market share. And so they're wondering what open banking is going to mean for them. But we have seen examples where big banks can continue to have their market share and can capitalize on people being able to look at what other products and services are available. I think that's the innovation challenge and the sales pitch for this kind of thing. And taking off my lawyer hat and looking as a consumer, I am interested to see on what I would be offered And I think that, we can all sort of think about that, whether or not we're part of the, on the various different sides of this debate. So the other thing that I would say too is that we are small in Canada, so we're looking at maybe a UK model or an Australian model, which is coming on the horizon. And in the US, because it's so fragmented and there are so many big banks are kind of doing their own open banking thing individually. So we have some of the big players. I think it's JP Morgan and Citi, and maybe I've got that wrong, but Wells. So they're creating their own open banking type regimes, but it's all, I'm not quite sure how that works if you're all creating your own. That doesn't seem to me like the principles of open banking, but certainly it's not like open banking and big banks are like, never shall meet. There's just, and we're conservative in Canada, right? We're nice and polite.
So if I could just piggyback on the question about the concentration. So it's actually more the norm than the exception that a national financial institution sector or finance sector is, with a high Herfman-Herfindahl index, if that means anything to you, or C4, like how concentrated the largest 4 or 5 market players are, like their market share. But we've actually been able to overcome this because if you think about the earlier studies I referenced, the Jankoff, McLeish-Schliefer, that the more information, full file comprehensive that's shared with the private bureau, the higher the growth rate in lending to the private sector as a ratio of GDP. That's a way of saying that it actually facilitates competition. That there's competition in lending in direct proportion to the quality of the information sharing sector. Now, how do you overcome this resistance to information sharing? Because you want to protect your market share, your margins. The trade-off is that you have a smaller slice of a much bigger pie. And that's, we've been able to show that in countries, again, empirical questions. Countries where there's been a change from negative only to full file, from partial full file to more robust full file. What's been the consequence in market share for the largest lenders? It's declined marginally, but the market overall has grown. So their revenues have grown and their margins have been sustained or have grown. So there is an ability to use data to help lenders who understand it overcome that fear. There's an opportunity. So it's really selling the information sharing as an opportunity, not as a threat. Sorry, other panelists.
I can take a shot at your question here about how do you look after the bad apples, and these aren't in necessary order, but I think there's a couple things that can be done. One is that as an association, as a growing association, we may choose to self-regulate that behavior by, let's say, coming together and putting together a charter, if you will, of what we will do and not do as lenders and participants. That's one way you could at least keep the bad behaviors limited. You can always rely on regulators to do it. My only concern there is make sure that if we were to do that, we don't inadvertently get those lenders or those regulators to do things that we hadn't intended them to do. Exactly. So you don't want them to have a giant purview. And I think as a free market supporter, I think there's a fine balance you have to structure there. And then I think the third thing is you got to punish the people who don't do what should be done. And I think punish is, I'll leave that in quotes, but I think you've got to make an example of them. The one thing I'll say in support of the ideas is usually these folks, when they get big enough, have a way of shooting themselves in the foot. Either because they can't run their businesses effectively, or they file CCAA and we pick up the remnants of whatever is left. We saw that happen with the cash store in 2015 when they tried to buttress the regulations at that time to try and blend between being a payday lender or line of credit, brokering their business. At some point, the Ontario government got involved and said, no, you can't do that, that, and that. All of a sudden, their business model went to blank, and they were out of business in less than a year. So I do believe you still have a lot of that peripheral type behavior going on that will always be there. The challenge is will consumers naturally go to those areas because they see it's a less friction and gets them something that, in terms of access to credit, more pseudo-mainstream lenders can't or won't provide. And I think you face that challenge in any Western-style country where you have pluralism and freedom of choice. But I think you have to mark off on some edges as what's not allowed and what's allowed. And I think you have to look at regulation, self-regulation, and what I'll call a level playing field. All three of those pinnacles, if you will. If you think of a three-sided pyramid, you've got to balance all of those three things at the same time. Not an easy thing to do. But that's how I would have you think about it as one way of approaching.
And sometimes on that in that particular example with the cash store, one of the regulatory fallouts was that yes, they went after that company. We also got some kind of weird, funky rules in the Ontario Payday Lenders Act because of that particular instance. And so that's always bad law when you get regulators drafting laws for a specific instance, because they're not drafting globally. They're drafting with this very narrow mindset, and that's the worst kind of law, and it's on the books, and we all have to deal with that. If you are a payday lender, and this particular rules were on lines of credit, so lines of credit offerings have to be considered with these funky rules.
I have a question about as a small fintech solutions or any kind of solution that we're providing information through the credit bureau about the borrowers, either structured or unstructured data, right? How can actually in return we can report behavior about the borrower that can actually improve the credit bureau and building on their credit score? So it's not just collecting data from bank transactions, but also on small lending platform, for example, or payday loans or something like that. How this can be returned back to the bureau as a creditor, for example, to report back the behaviors of the borrowers in return.
Maybe TransUnion?
Yeah, sure. I'll take a stab at some parts of that for sure. So I think that there's a couple of elements, isn't there? I mean, so there are some data types already which are reported to us where when we think about, for example, telecom data, which is typically negative data, but then when we think about other sort of data furnishers, by and large, the data that's kind of reported to us is the whole thing. So the good, the bad, and I guess the indifferent. But I think when we think about I think you mentioned payday lending in particular. So TransUnion acquired a company in the US called Factor Trust, and I know that there's kind of some interest and discussion about what that might mean in terms of Canada. And so essentially, what you're really talking about in the context of payday lending is well, how do you essentially create a non-prime credit bureau, if you like, where you would be able to sort of ingest and use that kind of information from the credit bureau perspective as well. So that there's certainly, I think, a way to potentially sort of solve the payday lending piece. And then the other types of data, I think, is something we need to explore as well. So we already talked, and Michael talked in his presentation about utility data and media kind of payment data, and I think that some of those elements could certainly be a part of the solution as well. We'll need to think about the sources of that data, how we ingest that data, how we kind of process and kind of use that data. But I think that definitely these are different elements of helping to solve that problem. Does that answer your question?
Yeah. And, for what it's worth, there's a group in the States called Credit Builders Alliance, and they're an association for smaller lenders, micro lenders, circle lenders, that don't necessarily have the numbers, the volume of loans that would attract bandwidth from national credit bureaus. Right. But collectively, all of them, hundreds of them, it's still pretty small relative to a Chase or a Citi. But they've succeeded. They've kind of overcome a collective action problem, coalesced, and that association helps them in terms of capacity building, understanding Metro 2, working with the credit bureaus to resolve issues of data integrity, reliability, So because you can't just report, they're not going to take data. It has to be a certain integrity. You have to be able to reliably report over time. So there's a certain threshold which has to be met by a data furnisher, and the furnisher, of course, has obligations under, in our case, the FCRA. So that's something where there are precedents to help smaller lenders be able to furnish into a nationwide consumer reporting agency. But maybe it's an opportunity for CLA. Maybe there's something in Canada, I just don't know. But that there is precedent.
I mean, as we talk about unstructured data, I was thinking about this could be, at least for now, part of this unstructured data as a source of data, for example, in addition to the utility bills and so on.
So there's a lot of data possibilities. So there's unfortunately right now more challenges than solutions, but solutions are coming. That's sort of the mother of invention.
Just to ask, interestingly, did you have thoughts about when you said behavioural data? Did you have anything in mind when you meant what kinds of behaviours do you mean?
So right now I'm actually talking on behalf of Lenmo is actually a lending platform that's connecting borrowers through data, right? And we're working actually with TransUnion actually.
Okay, good.
And what we had issues with, we have I think a decent traction for a startup right now, and we would like to report back the behavior of our borrowers on the platform. But we had issues because the volume that actually required, minimum volume required for that. But still, I see it could be an option for alternative data, for example, for a small platform like that, or payday loans and so on.
All right, now maybe we'll connect afterwards. I'm happy to
Sure.
connect and see if there's anything we can do about that.
Well, this was a very good Q&A, and I want to thank Michael for getting us started, setting the stage, and for each of the panelists for their free and open discussion. It certainly helped me get a better sense of the problem of credit invisibles. You know, from my own personal experience, and I'm sure it's the same for everyone else, whenever you go to the government with a request to change the law, their initial reaction, especially something as motherhood as privacy, will be to say, will be resistance and inertia. But research that you've done, confirming the suspicions that our panelists experience and see every day in the market, shows us that this is a serious problem, that this is not the 10% problem or sector of credit invisibles. It's a much bigger problem. And nothing will help focus a government's and regulators' mind that when they realize this is not a small issue, this is a big issue. And then they will be open to creative solutions. And your work and also the input of industry will be helpful. And whether that will happen, whether things like open banking may be part of the solution. And in that regard, I'm putting a plug in for the CLA's next workshop, which is on open banking, and it will be held on July 10th. For more information, go to the website. And again, these and other issues obviously will be the subject of the agenda at the annual Canadian Lenders Summit on November 20th. And for those who want to see any parts of this presentation, because there was a lot of information that was shared by Michael and our panelists, this session has been recorded and will be posted on the CLA website. So I encourage you to go back to your organizations and encourage other people in your organizations to view it. Anyhow, again, thank you very much to our panelists. Thank you very much, Michael.